All right, a very warm welcome to you wherever you're joining us from. This is My Chat with a Bank CEO, a series of conversation that we are bringing to you courtesy of the Kenya Bankers Association. We are looking at conversations from a banking and financial perspective, and today's conversation is going to largely focus on smart financial strategies to build and protect your credit score, and we'll be giving you more details about that. And we're live on X, we're live on YouTube, we are live on LinkedIn at Kenya Bankers as is the handle to follow. At Jim Cario is where you can find me, and at SBM Bank Kenya is the handle to tweet. Send in all your questions, send in all your pointers. If you hear anything or you have a comment on this conversation that we're currently having, if you have something to say or a question to ask related to the topic that we are having, please send in all your questions. We will be sampling them as we go along with this conversation. My guest this morning is Mr. Bhartesh Shah. He is the CEO of SBM Bank Kenya. He brings years of experience. We're talking about 2 decades of experience in the banking and financial service industry, encompassing diverse aspects of banking across East Africa, Singapore, the United Kingdom as well. He has also served as the Group Chief Operating Officer at I&M Group, and through his senior position at Equity Holding, Standard Chartered, Citibank, and Midland Bank. Bhartesh, how do you feel this morning?
I'm feeling excited.
Welcome to the program. I want to give you the floor to just make your opening remarks, and then we'll pick it from there in terms of just digging deep into this conversation that we are having today. And remember, we are live on X, we're live on LinkedIn, and we're live on YouTube. So use this platform.
Thank you. Good morning, and good morning to everyone who's joined us and will join us as well. So just the background, look, I joined SBM about 18 months ago. When I joined, it's in our published accounts. Last year, we made a loss for 1.3 billion. We just announced our first 9 months results earlier last week, and we made a profit of 412 million. So this is part of the turnaround strategy. And the reason why this discussion is close to my heart is, when you look at our strategy and our customer base, our target base is what I would call the missing middle. On the retail side, I would say call it the mass affluent. And on the corporate side, I would call it the SME. Mm-hmm. And in my view, there's no bank in Kenya that dominates those sectors. And it's our aim to see if we can dominate those sectors as well. And so this conversation comes at a timely moment for us.
The missing middle, that's quite an interesting tag to use, because so the conversation that we have been having largely has been seeking to reach out to the MSMEs. There seems to be a rat race or a foot race when you look at banks just trying to address the issues that are coming from this sector. It's one of the sectors that, creates the most number of jobs. When you look at the region, not just here in Kenya, when you look at the entire East Africa region, the MSME space are the biggest creators of jobs, creating about 90% of all the jobs that are being created in these different markets. So when you look at the space, at that space, why is it important for banks to address the issues and the needs of the customers in that base?
If you step back and think about Kenya and Kenyans, right? The one thing that I think most of us will agree on is that we're entrepreneurial, mm-hmm. right? Unlike most other countries, and I've had the privilege of working and living in quite a few countries. Kenyans are entrepreneurial, so by their nature, they will start a business, a side hustle, whatever you want to call it, right? And you're right, that's what creates the jobs as well. Now, generally speaking, when you look at the banking industry, in many ways, it's still a traditional model, right? Where you're relying on security. Now, this is a segment where, as you said, millions of Kenyans are within this segment, but they don't have real tangible security, land or buildings, etc. Right? Yeah. So the bank that figures out how to address that need without the need of physical security is the one that will have a head start.
Mm-hmm. So when you look at today's topic, we're just looking at smart financial strategies to build and protect your credit score. When you interact with SMEs, why is credit score an important aspect of their financial well-being?
Sure. Let's step back and think about and just try and understand what is a credit score, right? Mm-hmm. And why do we need it, right? Without going too technical, if you look at the global accounting standards, there's something called IFRS 9. Mm-hmm. And basically what the accounting standards say that, look, if you give out a loan, even if it's performing, you have to put a provision against it. And the amount of provision that you put on it is based on the probability of default. Mm-hmm. Now, the probability of default is one of the main calculations of that is the credit score.
Yeah.
Right? And the credit score is nothing more than an algorithm that, based on your behavior, tries to predict what is your probability of default. Is it 1%? Is it 0? Is it 90%? What is it, right? So when you have a customer that comes in which doesn't have any security, land or buildings, who probably hasn't been in the business for that long as well, maybe 2-3 years, right?
Yeah.
Then you've got to analyze their cash flows and look at their past behavior. And their past behavior is given by the credit score. So that's why it's absolutely critical for customers to understand what a credit score is and how do they maintain and improve it as well.
And speaking of a healthy credit score, I mean, this is a term that maybe we keep hearing about over and over again. But the question that comes to mind is, what does that look like? What does it entail for someone to come and say, I have a healthy credit score?
So, the definition of healthy would differ from bank to bank.
Yeah.
What I mean by that is each bank has a different risk appetite, right? You might have bank A, which says that, look, I'm willing to take a loss of 5%. While you might have another bank which says, look, I'm willing to take a loss of 15%, right? So the healthy credit score for a bank that's willing to take a loss rate of 5% would be pretty high. So, the scale goes up normally up to 900, right?
Yeah.
So they'll say that, look, I'm willing to take anyone who's over a score of 700 and above, which will give them their 5% loss rate, right? While the other bank, which is happy with a 15% loss rate, will say, look, I'll take someone from a 400 and above, right? But what I'd say is that aim to get your scores above 450 at least.
Yeah. So the thing that we see, and especially here in Kenya, is the question and the conversation around credit score only happens when I'm thinking about getting a loan from a financial institution. So the question that then comes to mind is, why is it important for customers to actively build and maintain a healthy credit profile?
I'll give you a personal example, right? So I have two children. My daughter's 21, so she's nearly at the end of her university, undergraduate, right?
Yeah.
But as soon as she turned 18, right, I got her a credit card. Simple, just put a fixed deposit in the bank, small, 25,000 shillings, and get a credit card, right? And I explained to her that when you spend on it and you pay it off and how often you pay it out builds your credit score. She didn't need credit at that time. She's not earning anything, right?
Yeah.
I was privileged to send her to the US to study as well, right? Now remember, she's never been to the US. When you go there, they have no history about her from a credit or banking perspective. But now credit scores are shared globally. So she was able to use her credit profile and score in Kenya to get a credit card there, right? So it is something that banks, not just in Kenya, but globally rely on as well. And many credit scores in Kenya now are globally portable as well.
Yeah.
Right? So when you do need that loan, that opportunity comes up for a business or expansion of your business,
Yeah.
one of the things that you've got to know about what is your credit score, because that helps you negotiate as well.
All right, and particularly speaking to players within the MSME space, there's a question around why is it that most of them become hesitant to address or to meet up with their banker or their relationship manager in terms of, and just having that conversation and telling them, I'm struggling, I was expecting the revenues to be at X, but they haven't gotten there. So why do you think a lot of customers are hesitant to have that conversation?
I think it's human nature, right? It's fear. If you look back at school, if you did something wrong, first impression would be, listen, I don't want the headmaster or the teacher to know about this, right?
Yeah.
Bankers, we're in a way perceived as too aloof. In many ways, that's correct as well, right? And the fear is that, look, if I tell them I'm in trouble, rather than helping me, they'll cut the taps and put pressure on me. Well, that's not the case, right? If you look at it from a bank's perspective, it's in our interest, even when you're struggling, to help you thrive so that we can get the money back that we've lent to you as well.
Yeah.
So I'll always encourage customers that as soon as they see, I won't even say troubles, but let's say cash flow cycles differ, right? Your customers take longer to pay you, etc., right?
Yeah.
Start having those conversations. And most banks will be able to help you out, either do a restructure or extend the term, etc.
Yeah. So does it make a difference at what point I have this conversation with my bank? Does early engagements then help me as a customer?
As early as possible, because it helps the bank think of options to give you. Because if you leave it too late, the options the bank can offer you would dwindle. It'll narrow down. But the earlier you talk, you can at least, they or the banker will be able to discuss at least 3 or 4 options with you.
Yeah.
And you would understand your business better than anyone else. And it would make sense which option makes sense for your circumstance and what your business is going through.
All right, so there is a financial aspect and quite an interesting interaction between customers and their banks. When you look at affluent customers, they will go to their banker and say, I'm thinking of making this financial decision. What can you advise? But for a lot of retail customers, they don't tap into that aspect of the bank. So what needs to happen to ensure that even retail customers take advantage of that?
So, it's a transformation that we're undertaking here, but to be honest, many banks are undertaking as well. If you read the newspapers over the last couple of years, every bank would talk about digitization,
Yeah.
etc. Now, one of the potential outcomes for some banks, not for all, on digitization is that you change what a branch is. A branch in many banks today is a place where you go and transact. Now, if you move the transactions to the mobile phone,
Yeah.
then that space is used for advisory. You can walk into a branch and say that, look, I'm thinking of importing something from China. What is there? They may not know what an LC is or what a guarantee is. So someone who can talk to you about that as well.
Yeah.
But then, especially if you write to the banks, every bank today has a social media handle, they have an email address. And most banks, in fact, I would say all banks, actually follow the KBA banking charter as well, where we would respond very quickly on those as well. So someone will either call you or would email you and have a discussion as well.
All right, so just to remind you who's following this conversation, wherever you are, you can be part of this conversation only by sending in your questions or comment on the comment section. If you're following the conversation on YouTube, if you're on X, you can post there your question and we'll be sure to sample some of them. So Bhartesh, I want to take you back a couple of steps.
Sure.
Now, you've talked about restructuring your facilities. And the question that comes to mind, and for a lot of customers, the one thing that they would want to know is there an extra cost when I go to a bank and tell them, okay, I know I have this facility, but can we talk about restructuring?
So let me use an example from recent times to answer that question. Now, if you remember, over the last sort of 18 months, right, interest rates really shot up.
Yeah.
Right? You had T-bills going from about 9% to about nearly 17%, right? And obviously the bank's cost of funding went up as well, right? And nearly all banks increased their rates to customers who are borrowing, who are on floating rates, right? Now, if you're salaried and you'd taken out a loan and your monthly repayment was 50,000 shillings, you'd already factor that in your budget.
Yeah.
But when interest rates go up, all of a sudden next month you're supposed to pay 60,000 shillings. I'm just using an example, right? Now, your salary hasn't gone up by that much at all, right? And you've had further deductions by higher taxes, etc., coming in. Now, when you come into the bank, one of the options that they would say is that, look, to keep the monthly payment the same, let's elongate the tenor, right? So that when interest rates come down, we can either pay more or reduce the tenor as well.
Yeah.
So when you elongate the tenor, it helps you stick within your monthly budget of 50,000 shillings. But by elongating the tenor, you end up paying more in interest.
Yeah.
So there is a trade-off with with most restructures, I would say. There is always a trade-off.
All right, and it's a wonderful thing that you bring out the aspect about rates and negotiation. And I want you to help my viewers and my listeners this morning in terms of when they go to a bank, how then do I negotiate for better rates? What are some of the tools that will help me get lower rates?
So, the new risk-based credit pricing model that the central bank has launched in conjunction with KBA as well, right?
Yeah.
Most banks, in fact, all banks are expected to go live for existing customers by the end of February next year. I mean, we'll be going live very soon, and you'll hear about that as well. But I think that is a perfect example where it brings in transparency.
Yeah.
So you'll have a reference rate, which is either K SONIA or the central bank rate, plus K. Now, part of that K is your personal risk score, right? So how much of that interest you're paying based on your score.
Yeah.
Right? So if you have a very good score, the bank has to tell you that, look, based on your score, I'm adding 1% or 2% to your rate, right? But then if you say that, look, I have a 900 credit score, which is nearly perfect,
Yeah.
then you can shop around and actually get a much lower rate because every bank will be following the same broad formula.
And And we'll be engaging more about Kesonia and the opportunities therein, and especially for customers. But let's talk about this question around credit rating. And there's one thing that a lot of customers seem to struggle with, and that is what then determines my credit rating? Is it my repayment ability? Is it my cash inflow?
So there are multiple factors that goes into calculating your credit score, right? But essentially, at a broad level, it's how has your financial behavior been, right?
Yeah.
Now, remember, all banks are required by law to submit every borrower's details to the credit reference bureaus in the same format, right? Whether you're paying, whether you're defaulting, or whether you're late on your payments, etc., right?
Yeah.
So what that data tells the credit reference bureau, what are the loans you've taken out? When did you take them out? What is your monthly repayment?
Yeah.
And how have you been fulfilling those repayments, right? So if you've been fulfilling your repayments, it helps your credit score. If you miss one, it hurts your credit score. If you miss three in a short period, let's say within a year, it hurts your credit score even more. Because what that tells the credit reference bureaus through their algorithms is that you're struggling to meet your financial obligations. Therefore, your risk of default goes higher. So as long as you meet your financial commitments, as long as you're repaying your loans on time, as long as your overall indebtedness over a medium term is going down as well,
Yeah.
all of those factors are the main, so these are the main factors that will go to help your credit score.
All right. And speaking of overall indebtedness, there's a question around having multiple credit providers. And I want to know, does that have a positive or a negative impact? For instance, if I come to SBM and SBM tells me we can only give you a loan of X amount, I go to another bank who will tell me we can only give you a loan of X amount. So if I combine these two, then I will be able to do the project that I want to do. So does this then help my credit score, or does it make me a riskier borrower?
As long as you are your repayment history with both of those loans is current, you've paid all your monthly or quarterly installments on time, it makes no difference to your credit score.
Yeah. So in terms of credit information sharing, are these two banks then going to share my information and say that, oh yeah, Jimmy has a facility here, he also has another facility with you guys, so how do we treat him?
So when you go to a bank and let's say apply for a facility, they'll go to and query the credit reference bureau using your ID number, right?
Yeah.
That report will show all the loans that you have with every credit provider. So it'll show how many mobile loans you have, right? If they're submitting, right? How many bank loans you have with which bank? What was the original amount? What was the monthly installment? And how have your payments been against those as well? Have you had any bounce checks, for example? It'll have all that detail. So the banker will be able to see your entire picture across the industry. Who have you borrowed from, and how well has your repayment been?
Yeah, so when speaking about strategies around borrowing, what do players in the MSME space need to know about their credit worthiness or their credit risk?
When I look at the MSME segment, generally speaking, most of them require short-term working capital, right? They're not at the stage where they're going into big capital projects. They want to build big go-downs or factories or things like that, right?
Yeah.
So the most efficient way today, unfortunately, is also the most expensive way, which is the mobile loans, right? As well. But if you go to a bank and explain what you're trying to do, and you have cash flows and projections, right?
Yeah.
It doesn't need to be a fancy model, as long as you have those, right? And your bank statements can show your ins and outs of cash coming in and out. That's the first step. Because getting funding from a bank will always be cheaper in current circumstances than a digital-only lender.
Yeah. So how, and again, an interesting aspect that you're bringing out, and this is around digital credit providers. The prevalence of this has gone up. The number of digital credit providers has increased in the market. Now we're talking about over 500 that I believe have applied and been accredited by the central bank. So then, when you look at customers, from a customer's perspective, this looks like I have more options now to be able to access this credit. So how do we use these platforms then to help build our credit score?
So One of the main reasons, in my personal opinion, why we've had so many digital trade providers mushrooming in Kenya is because of what customers see as the convenience. I can go on my phone, download an app, and within minutes, if not less, get money in my M-Pesa wallet, for example.
Yeah.
Right? But the question is at what cost, right? Now, with most banks, some banks have gone digital on their apps, right? But not many. But many banks are working towards that. Now, if you had that same convenience from a bank where you can go into your app and say that, look, I want a 1 month or a 3 month loan for 50,000 and decision straight away, and if approved, money is credited straight away, that would really work at a much cheaper rate for the customers. So,
Yeah.
you know, just to plug in SBM, we've started doing that with our existing customers, and into next year we'll be moving into, in a slow manner, but in a test manner, to non-customers as well. But there are a few other banks that have done this as well.
All right, so can you talk to us about the metrics that you're currently using in terms of just determining that this borrower, we can only give them a certain amount and not maybe what they're asking for?
Sure. So the one critical piece of information that banks need, which is not on the Credit Reference Bureau reports,
Yeah.
is your income. Right? It'll just tell you you've got so much loans and that's your monthly installment, right? But it doesn't tell you what your income is, right? So one of the things that we do with our existing customers is analyze their banking activity, right? And from there, deduce that consistently, what is the credit coming into the account? So that's a proxy for your sales or income,
Yeah.
right? And then we then apply a proxy for your expenses to come to your, let's say, profit margin. Now, all of that determines just one thing, your ability to repay, right? Now, let's say your ability to repay is 10,000 shillings a month, just
Yeah.
as an example, right? Now, what that'll tell us is that if your ability to pay is 10,000 a month, then if you want a monthly loan, we'll give you 10,000, right? But let's say you want a loan over 2 years, right? Then it's just a simple calculation. If the interest rate is X and monthly repayment is 10, what is the principal amount?
Yeah.
Principal might come out to 200,000, for example. So that's how we determine it. So the main, at least from a banking perspective, apart from the Credit Reference Bureau score, the main determinant is the activity on your bank account,
Yeah.
right? What's your ins and outs?
Okay, so let's talk about the tenure of these facilities. Does that benefit me as an SME, or because the trend that we keep seeing, and especially within the Kenyan market, is that a lot of businesses and a lot of retail customers will go for short-term facilities. So if we were to switch that and maybe have them going for long-term tenures, will that work for them or work against them?
I think I'd rephrase the question. What I would ask myself is, what is the problem the customer is trying to solve? In simple language, look, if I'm a retailer selling water, right?
Yeah.
I'll go to a wholesaler, buy the water, sell it, and next morning I'll buy more, right? So my need is working capital on a daily basis,
Yeah.
right? If I'm buying bags of cement, I know that I'm going to sell them in 7 days. My working capital is 7 days. But if I want to build a shop, it'll take me 6 months to build. It'll take me maybe 2 or 3 years to recover, right? Then I'll need a longer term facility, right? So for customers, I'd always advise match the financing requirements to what you need it for, right? And this is where I distinguish banks from digital credit providers as well. Generally speaking, in a bank, whether you go for a shorter tenor, 1 month or 2 years or 3 years, the pricing differential isn't too much.
Yeah.
But when you compare, let's say, a 1 month loan from a typical bank compared to, let's say, a digital credit provider, generally speaking, the difference can be quite marked.
All right, so let's talk about Kesonia. And the thing that we all know is that players within the financial sector and bankers especially, they have welcomed Kesonia into the market. But then the question that I want you to help us understand, for customers, how does Kesonia then benefit me?
Okay, so probably I'm jumping the gun and I'll get into trouble, but let me just say this, right? I mean, our board just approved the risk-based pricing mechanism. Our notification to the central bank is going out today itself. Now, The regulation gives banks an option of K-SONIA, which is preferred, or as a fallback, the central bank rate, right? Now, whichever one that you use, what it gives the customers is transparent predictability.
Yeah.
Because what happens today? Most banks use their own base rates, right? And Bank A's base rate would be different from Bank B's base rate, right? And as a customer, you wouldn't know what goes into it, right? You'll just see a notice in the newspaper or a text or an email saying, from this date, our base rate is going up or down, right?
Yeah.
But now, with a independently verified rate, whether it's CBR or K-SONIA, it's public, right? So whenever that changes, you know that your rate is going to change because your loan is linked to that rate. So it provides that transparency that hasn't been there so far when banks use their individual base rates.
Yeah, because the question that we've been getting from a lot of customers and a lot of Kenyans that we engage with is that once the CBR goes up, banks are very quick to implement it. Once the CBR cuts rates, we don't get to see that translate into our loan portfolios. Now, the other thing that has come up is this argument that you will hear from a lot of your customers, which is, I have had fairly healthy credit history, but my rates are yet to come down. I'm still paying standard rates. So how then do we make sure that going forward, even these customers there will be a difference in terms of this customer A who gets charged at 9% and customer B who's getting charged at 11%?
Sure. So let me address two parts of your question.
Okay.
The first one, when customers say when CBR goes up, banks are very quick to raise it. When it goes down, they're quite slow to do it, right? If you think about it, the bank's funding model is I get deposits and I lend it out to customers, right? Now, if you have placed a fixed deposit with me for 12 months, right, I've fixed a rate for you. If I come back to you after 3 months and say, look, CBR has gone down, I need to reduce your rate, you're going to say, take a walk, right?
Yeah.
So it takes a while for the bank's funding costs to sort of mirror the reductions in the CBR and the treasury bills and all of that. So that's why they see that delay as well, right? But now to the second part of your question. With this new risk-based credit pricing model, right, as a customer, Jimmy, when you come in, your bank will tell you, hopefully it's SBM, will tell you your rate is, let's say, CBR plus K.
Plus K, yeah.
All right? So let's say K is, for argument's sake, 4%, right? So you know CBR today is 9.25 and your K is 4, right? So your rate is 13.25.
Yeah.
So whenever CBR moves up or down, right, you can calculate for yourself. Let's say CBR goes down to 9. So your rate from 13.25 has gone down to 13, right? If it goes to 9.5, your rate goes up. So you've got 100% transparency and it's almost immediately. Remember, we have to give notice under the Consumer Protection Act and various other things, at least 30 days. So, but you know that within 30 days, your rate's going to change.
Yeah.
It's not going to be months or unknown time, right? It's going to be within 30 days.
Okay. So let's go back to today's topic, which is looking particularly at strategies. And the one thing that I want you to help us understand is, so for customers and especially players who are doing businesses and running different enterprises, one thing that I need you to help them understand is how to balance when, let's say, cash flow tightens and I still have obligations. I still need to restock my business. I still need to pay my suppliers. So how do I go about prioritizing which payments to make first?
What I would say is that from a business perspective, number one is you've got to make sure you make your statutory payments. Whatever tax payments it may be, VAT, withholding taxes, etc., right? Because that alone has the ability to shut your business down instantly, right? I mean, the various regulators have that power, right? So number one should be statutory, right? Then second should be what is going to enable you to continue doing business, right?
Yeah.
If you can negotiate, let's say, slightly longer terms with your suppliers, that's great. But if you need to pay them to get your next level of stock so you can sell and hopefully trade your way out of it, then probably suppliers as well. But then banks as well, right? Because banks can help you, but if you leave it too late and banks start taking the remedies available to them in law, again, that could shut you down as well. But have those discussions earlier on as well.
Yeah.
And the one thing that I'd advise is, look, I've been in the banking industry now for nearly 28 years, right? One of the key problems that I see in sort of the MSME or even the SME space as well is, Jimmy, you're trading well today, you're doing your business, it's going well, right?
Yeah.
You mistake the cash flow going through your account to be profit. You have a conversation with your friends over a meal, over at a bar or whatever else, and you decide that, look, we're going to build this block of flats, right? And what a lot of people unfortunately do is take cash flow, which their business depends on, which is the lifeblood, the oxygen of their business, and put it into a long-term project. That, in my opinion, in my experience, has taken down a lot of businesses.
Yeah.
So if you have that idea, don't look at cash flow from your business. Talk to your bank and see what other financing options are available if you want to build shops or flats or whatever.
All right. So in building that credit score, Bhartesh, so the question that I'm sure any entrepreneur would want to know is, when do I go to the market to seeking for credit? At what point? Because if I establish my business today, of course, tomorrow I cannot get the credit, the kind of credit that I would want. There are businesses that have also said, I will continue relying on my cash flow as opposed to going to the bank, which again works against them when it comes to building that credit score. So talk to us about the timing of going to the market for credit. What do I need to consider?
I'll use the same example that I gave earlier on in this conversation about my daughter. As soon as she turned 18, I talked to her, explained to her what her credit score is, and she started building her credit score.
Yeah.
Even though she didn't need credit, she was going to be in university for 4 years. You got to build it as early as possible, because that's the only independent information that a bank would have, right? So even if you're relying on your internal cash flows, I would still strongly advise to build a credit.
How do they do that?
Take a loan, pay it the next day. Simple as that. There's a small cost to it, right?
Yeah.
Unfortunately, that's the way the world works today. As we go more digital, as we rely more on sort of models and algorithms to make decisions, right? They will always look at credit scores. And we're talking about MSMEs here. We're talking about millions of customers, right?
Yeah.
You're not talking about a huge, let's say, company that's got billions in profits, where you can have a discussion one-on-one. To have that conversation one-on-one with millions of customers, the industry just doesn't have the capacity. So it has to rely on models and algorithms to make those decisions.
All right. And again, so you say take a credit and repay it tomorrow. But for a lot of these businesses, they'll say, but I don't need the credit, so why should I get it? What benefit does it make for, does my business get out of that credit facility? Because again, they will argue there is that extra cost, there is that 10%, there is that 11% that I'm paying in interest.
The examples you give, I think, in terms of rates, relate more to the digital credit providers.
Yeah.
But even if you talk to your bank, right, so you've started your business today, right, and you're running it, it's going well, you're financing everything out of your cash flows, right?
Yeah.
But let's say you have ambitions and you want to make a plan. In 2 years or 3 years, where do you want to be, right? So it's doing a projection and then looking at, okay, will my cash flow be enough to fund my aspiration for growth in the next 3 years? If not, do I need some facility, right?
Yeah.
And that's when you go to the bank. It's planning ahead.
Okay. All right. So again, let's talk about internal controls that businesses need for their operation to make sure that then they do not miss any of these credit obligations that needs to be settled. What would you recommend?
So look, what I'd say is that if you've taken out a facility and let's say the payment is monthly, for example, do a simple standing order or whatever, right? And make sure it's paid. Don't miss a payment unless you really have no other option left, right? If there's a choice of putting food on the table or making a bank payment, obviously most people will choose putting food on the table, right?
Yeah.
But unless you're there, make sure you just make those payments, because you would be, generally speaking, people miss payments because they're so busy and they'll forget about it, right?
Yeah.
And to be honest, one of the other information that we particularly look at is, okay, you've missed a payment, but by how many days, right? If it's a week or two, we understand life happens, right?
Yeah.
That's okay, right? But as much as possible, meet your payments on time. And the other thing I'd advise as well is try and make sure that all your sales go through your bank accounts, right? Let's be honest, we're in Kenya, and yes, things have changed, but a lot of business is done in cash, right?
Yeah.
But today, with KRA going digital and banks' credit decisioning going digital as well, stay away from cash business as much as possible.
Okay, that's quite interesting because again, there are those who still believe that cash is king. But moving on, so what metrics can then help guide these business owners and these customers in terms of making that borrowing decision? What metrics do they need to consider?
I would say the most important one is ability to repay, right? So you want a facility of X, your monthly repayment, for example, is going to be Y, right? You've got to be comfortable that your business can afford Y,
Yeah.
right? But then perhaps go one step further, right? If something negative happens, right? Business goes down, interest rates go up, taxes go up, etc., right? Do you have some headroom? So if you can, say for example, if you can afford to pay 10,000 shillings a month as a repayment for your loan, right? Don't take a loan at that limit. Give yourself some headroom. Take it, let's say, take a loan with an amount at 8,000. Because you need to factor in unforeseen, the unknown unknowns, as I call them, the unforeseen events, right? And we've seen a lot of them happen over the last couple of years, right?
Yeah. So how often should I then reevaluate my credit health? And what tools do I need to do that? What do I look at?
What I'd say is that at a bare minimum, look at it on an annual basis. Every credit reference bureau in Kenya gives you your own personal report for free once a year. Get it from them. They'll email it to you once they verify identity and everything, right?
Yeah.
And then just look at it, right? And if there are any changes in the score, or if there's any information in the Credit Reference Bureau that you think is incorrect, please contact the Credit Reference Bureau and your bank immediately, because that can and should be corrected.
All right, and just to remind those that are following this conversation online, we are still looking around to see if some of you have sent in any questions, and we'll be trying to sample some of them as we go on with this conversation. So if you have any pressing questions related to the topic that we are having, which is smart financial strategies to build and protect your credit score. So, and Bhartesh, speaking about protecting that credit score, apart from just repaying the facilities that I have, what else do I need to do to make sure that my credit score is protected? If I'm rated positively today, what do I need to do and ensure that I stay in the positive?
I mean, look, the other factors that are in the reporting templates that bank report, which obviously form a factor into the algorithms the CRBs use to calculate your score, are things like bounce checks. Right? So if you have bounce checks, that will affect your credit score negatively as well, right?
Yeah.
And inconsistencies in your, what I call static data, right? If you have, and it happens to all of us, people change email addresses, people change mobile numbers, etc. If there is too much of it, it raises a question mark. It's not necessarily negative, but it raises a question mark if there's too much of it, right?
Yeah.
So if you borrowed from 6 banks, right, and there are, let's say, 12 different email addresses, it raises a question.
Yeah.
Right?
Yeah.
So, but I would say the main thing would be the consistency of your repayments, how well you've repaid, how many loans you're taking, and how well they're performing. Because ideally, over time, you would see, one particular loan, the outstanding value to go down over time as well. If it doesn't, it means it's being restructured.
All right, so let's talk about the realities of businesses and especially small businesses today. We're talking about a market that is quite volatile. Things happen in our neighboring countries and we feel the impact. Things happen globally and we feel the impact. Do you feel that financial institutions and specifically banks are prepared and are ready or fully understand the different realities of small businesses?
I think banks are starting to get there. And I think it started with COVID, right? Remember, with COVID, it was a major event globally, but particularly in Kenya as well, right? If you look at hospitality industry, every industry was affected, right? So banks, again, with the help of CBK, restructured a lot of facilities at that time, right? Now, if I look at SBM, and I give you an SBM example, right? When a customer comes for a loan, yes, we assess the ability to repay, etc., right? But we also do something what we call a stress test, right?
Yeah.
If something unforeseen happens, interest rates going up, some geopolitical event, etc., right? We factor that in. What if interest rates went up by 5%? so that we make the responsible choice to give a facility to a customer which they can afford even with a bit of volatility. Because you don't want to be caught out when this thing happens.
All right. So when you look at the behaviors and the characters of retail customers and small and medium enterprises, what is the most common mistake that for our viewer who's watching and following this conversation, they need to avoid before making that similar mistake?
I think it's intentionally or knowingly not paying a loan, right? Because you know, for some customers, the psychology would be, okay, look, they don't have any of my security. They don't have my house or my car, right?
Yeah.
So they'll come and chase me. I'll pay them after 6 months, right? But the damage that not paying that installment or those installments in the 6 months that it does to your credit score will unfortunately take years to unwind. Right? That's what they miss out. So when you intentionally delay a payment, right? I think that's a mistake.
Yeah. So how long does it take to repair bad credit history?
At a minimum, it'll take a year. It'll take
At a
at
minimum.
least, at a minimum, it'll take a year. So it's a consistency of it as well, right? Because what the algorithm does is build on your behavior month on month, right? So it first in, first out, right? So it takes a bit of a while. But in reality, I would say from what I've seen, at least a year.
All right. So let's go back to something that we have seen, and a lot of customers have complained about this, that as of last year, I would get, let's say, 100,000. If I went to a bank and said that I need credit for X amount, I would get the exact amount that I need. But today something happened in between, and now I'm only eligible for 50,000. So can you tell us what changes in between that leads to that reduction in the in the quantum of the credit that I can get?
I mean, without having specific examples, just generally speaking,
Yeah.
what we've seen is interest rates going up over that period as well. You've seen the NPL rates remaining elevated for a while. If you look at industry NPL rates, the last available data is that they're at 17.1%,
Yeah.
right? So that is still elevated as well. And obviously that's a function aggregate of all the banks' NPL ratios as well. And that's not going down. If you look at the graph, it hit a high of 17.6 earlier, but then it's now at 17.1, but still very high. So I think banks are trying to manage the experience that they've had with the NPLs. So in segments or sectors where NPLs have been high, many banks have reduced their risk appetite, which would possibly result in those loans facilities going down. Again, this is a general example.
Yeah.
But it would depend on the specific circumstances.
All right, so let's go on X, where we have a couple of questions that are currently coming in.
Sure.
We have at Jade Mudhoni, who asks, if my business isn't registered yet, can I still start building a credit score, or formalization is the first step?
No, it's a great question. Look, when you look at the MSME space, right, even if it's formalized, at the end of the day, it's that person behind it as well, right? So what most banks do is look at the credit score of the individual as well, right? So absolutely build your personal credit score, because that will help in a long way. Because even if your business isn't registered, the bank will rely on your personal credit score.
Okay, so we also have at Ali Ochieng, who asks, what is the fastest way for small tailoring business to move from informal to formal operation without huge costs?
Look, I think from a funding perspective, again, based on your cycle, if you need to buy, let's say, material, your customer comes in, fits it out, and let's say it takes you 2 weeks to turn around a shirt or a suit, right?
Yeah.
Then you need shorter term funding, right? So you need to understand how long does it take when you get your raw material to when you get paid for whatever you've made, right? And get your funding for that and increase your cash flow. As you increase your cycle, you'd need either more sewing machines, or you'll need to employ more people to help you, because you as an individual can only make so many shirts in a day, right? So I would say plan it out. And then when it comes to sort of formalizing it, it goes back to the basics. You've got to make sure that you put a brand out. With social media today, You don't need to advertise in the newspapers. You can build
Yeah.
out your brands with the help of your customers about your tailoring business.
All right. Susan Karaoke is asking, do banks treat youth-led businesses differently when it comes to credit scoring? And number two, how can we leverage that?
So apart from the Credit Reference Bureau score, banks look at different things, and each bank would differ as well, right?
Yeah.
Your age makes a difference, but not that big a difference, right? But say, for example, again, this depends on the product, but the fact that you're married or not, right, makes a difference as well in a positive way. Because statistically, if you look at historically, the more responsibility you have, and marriage is a proxy for that responsibility, adds to your credibility as well,
Yeah.
right? So there are a number of things that go into it, but age on its own, not that much.
Okay, okay. So we also have Fatuma who's asking, what is the most overlooked steps that MSMEs take that hurt their credibility with banks?
Two things I would say. One is, you know, delaying repayments of loans, which will affect your credit score, right? Don't delay it unless it's absolutely necessary. And second is spreading your cash flows across many banks. What do I mean by that? If you decide to have five bank accounts, you have, let's say, an M-Pesa wallet, etc., right? And if your cash flow is spread across 5 or 6 different banks, right?
Yeah.
As SBM Bank, for example, I would only know what goes through your account, right? So for me to digitally provide you with a service, I'd base my analysis on what goes through your SBM account, right? Now, obviously, if you come in with the statements of the other banks, then I can have a fuller picture. But that takes time, while in most cases, MSMEs need money instantly.
Okay, okay. And speaking of delaying your repayment, what is the acceptable period that you're allowed as a business to say, okay, I've had an issue that I need to be able to sort out. Can we agree that I will repay this loan at a later date?
Look, from a bank perspective, as long as you explain to the bank the rationale and the reason for the delay and how you're going to make that payment, not an issue. It'll be based on the time. They're like, okay, let's restructure it 30 days, 60 days, 90 days, some cases even a year.
All right. So will that cost me more?
No, it shouldn't.
Okay. And thank you for all your questions. If you're still following this conversation, please send in more questions and we will try to sample as many of them as we can. And we're just getting great feedback that is coming from you. We have Kama Namai who says, great conversation and enlightening. So, Bhartesh, there is one thing that a lot of MSMEs struggle with, and that is access to credit. On one hand, we have banks that are saying, come to us, we'll give you the credit. On the other hand, SMEs are saying, when we come to the bank, we're not getting the credit that we're looking for. So where's the disconnect and how do we address that going forward?
You know what? One thing I'd say is that in the recent past, right?
Yeah.
The banking industry, like I said, the NPL rate right now across the industry on average is 17.1%, right? Now, unfortunately, a large contributor or a growing contributor to that has been the MSME space. And again, when you sort of look at the reasons behind that,
Yeah.
over the last couple of years, you've had disposable income for Kenyans going down, right? You've had housing levy, you've got the social health and everything else coming in, right? But incomes have not gone up by that much.
Yeah.
So as disposable incomes go down because of the higher taxes and levies, right, we've seen demand in the economy go down. Now, unfortunately, I mean, obviously that's hit every business, right? Every business. But the businesses that it's hit the hardest is the MSMEs, right? So that's contributed to higher NPLs in that sector.
All right.
And so a lot of banks have actually reduced their risk appetite for that sector.
Okay. So there's something that we again, another similar trend that you will pick within the Kenyan market, and especially when it comes from businesses, is that as long as or as soon as my business starts to struggle, my first thought is I need to go to the bank, I need to recapitalize the business without necessarily knowing when the turnaround is going to take effect. So is that a good strategy or is it a risk and is it worth taking?
I would say 100% go and talk to your bank as early as possible. You may not know for certainty when your business will turn around, right? But you need to give a projection, which is based on some realistic assumptions.
Yeah.
Not hope, but some realistic assumptions, right? And
Yeah.
then you can debate, discuss it with your banker, and they will be able to restructure it. Remember, a banker, whenever a loan goes past certain days past dues, they have to make big provisions for that, right?
Yeah.
They will try and avoid doing that as much as possible. So as long as there is a feasible way to restructure that facility to help the customer and then eventually help the bank recover the money as well, they will do it. So it's in the bank's interest to talk to the customer as soon as they notice they may have an issue.
So, how realistic is it for a small business to build a healthy credit score, but at the same time they're dealing with erratic revenues?
Look, I mean, okay, let me talk about from an SBM perspective, right?
Yeah.
Our approach is to give a, to extend credit based on cash flows, right? And the cash flows are spread over time. They will be erratic. One month will be different from the other, right? But as long as, let's say, you've got cash flows over 12 to 36 months, right? We've got models that can average it out and predict it
Yeah.
as well. So that's what we're using. And most banks are thinking of that. Some are starting to do it.
Okay. So, in terms of running capital, so for a business, how many months ahead should I be to say that I'm okay? I can run my business sustainably.
Look, I'd advise everyone at a bare minimum to have a detailed 12-month plan, right? And then as you grow, move to 36 months. Beyond that, predictability goes out of the room, right? But at a bare minimum, 12 months, because it helps you track month on month as well, right? That, okay, last month, my model or my budget, whatever you want to call it, said that I should be doing X in revenues, but I did Y, either lower or higher. Understand the reasons why. That'll help you understand your business better and to help you improve your business as well. So minimum, I would say, is 12 months, but review every month at least.
Okay, so let's talk about financial discipline and the things that, again, you will see a lot of SMEs maybe, and one of this is you tend to see a lot of SMEs because it's individually owned and individually run. You'll find that they're mixing the cash flow, and so when determining this person's credit flow or credit risk, what do you look at? Is it then the individual or is it the business? And how hard does that make it for me as an entrepreneur to get credit?
We look at both, right? Because as you rightly said, you
Yeah.
cannot differentiate the two, right? You take money from your business to pay school fees, for example, right? It's your cash flow, right? It's not like a corporate where, your salary versus the corporate's revenue are very different, right? We look at it singularly. That's why we look at, even though you may have incorporated your business as a sole trader,
Yeah.
we look at your personal credit score as well, because the reality is you cannot separate the two. It's
So-
one and the same.
So from the individual's perspective, from the entrepreneur's perspective, should I separate the two or should I keep mingling the two?
Look, let's be real. When you're starting out, right, inevitably, even if you wanted to, you'll end up keeping it the same, right? But you need to determine that once you get to a certain size in terms of turnover, you need to separate the two as well. I'd say that, look, once you're approaching sort of 1 million shillings a month in turnover, that's when you actually separate it, because there is a cost of separating it, of incorporation and all of that as well.
All right. So let's talk about the other disciplines that a lot of entrepreneurs then might need to get whenever you start a business. And what tips would you share?
One is borrow for growth, not for consumption, right? I've seen many people, your business is doing well and you'll borrow to buy a flashy car to show off. Adds zero value, right? If you borrow to grow your business, if you're growing for income, if you're borrowing to grow for income as opposed to borrow for consumption, always borrow for growth, not for consumption.
Yeah.
Because your car is a depreciating asset. As soon as it leaves the showroom, it's down 25%. Number two, don't buy into the latest fad. The example I gave, you're at a dinner, you're having drinks with your friends, and everyone's excited about how well real estate is doing and you want to go into that. Fine if you want to go into it, but don't take working capital from your business to fund a longer term asset, right? But the main one I'd say is that borrow for growth, not for consumption.
All right, so we have another question coming in from Philip Waliaro on YouTube, who says there has been a challenge with MSMEs in Kenya accessing credit due to lack of collateral. And he goes on to ask, how is the banking sector tapping into this space to help SMEs and particularly SBM?
So look, as a banking sector, KB has made a commitment to extend out to MSMEs, right? And that's largely without collateral as well. And that's tracked on a quarterly basis by the KBA on that as well. But particularly for SBM, we're going into cash flow based lending. So particularly for the SME sector, we won't even ask for collateral. We're going into cash flow based lending, which is basically simple way of explaining this. Looking at what you earn, looking at what you spend, determining what you can repay, and giving you a loan based on that.
Yeah.
Simple as that.
So when you talk about the future of credit and looking ahead, how do you see it shaping in the coming years?
It'll go digital, even more digital, where you'll have algorithms making that decision, right? With the advent of AI and sort of getting almost into quantum computing, you have so much resources available at a relatively low cost where machines will make those decisions. So you've got to understand what are the key inputs in that decision. As of right now, your credit reference bureau score is one of them. So that's why this conversation is important.
Yeah.
Make sure you monitor it.
So how do we then prepare to make sure that once we get into that space where machines are making that decision? You know, right now I can walk into a bank, I can talk to my RM and tell them, hey, there's this and this situation that I'm in that I need addressed. But once we remove that human touch, how then do we prepare for that?
So the algorithms will increasingly make credit decisions, right? But in the event you run into unforeseen issues where you need to restructure, there'd still be a human being. But eventually that'll go into machine learning as well. So one is being consistent, making sure that where possible, live up to your obligations. Because banking, whether it's done by a human being or a machine, is nothing but trust.
Yeah.
All that the algorithm will try and do is figure out the trust factor, which a human being is doing today. So what determines that trust factor, unless someone knows you for years, it's what's your history been?
Yeah.
Because your consistency is one of the great predictors of how you're going to behave in the future as well.
Okay, so as we wrap up this conversation, Bhartesh, I want to know from where you sit, and maybe you can use yourself as an example. What is the best credit advice that you've ever received, and what is the best credit advice that you think anyone who's following this conversation needs to include in their financial decision making?
I'll give you an example. You know, I had the privilege of doing my undergraduate studies in the UK.
Yeah.
This was in the early 90s. It shows you my age, right? Now, coming from Kenya, we never had credit cards in this market, right?
Yeah.
No one had heard of them here, right? So you go there, every bank wants student accounts, right? So one of the offers that they entice you with is a credit card, and they give you a limit at that time of £500. So yeah, you took them up, and I never knew how they worked. So I ended up in debt, a lot of debt.
Yeah.
And I had to work for very long hours in restaurants where students could work and etc. to repay that, right? So I mean, basically what that taught me is that look, credit is about trust, right? It's like any relationship that you would have with family, friends, your loved ones, etc. It's based on trust. Go into a credit relationship with trust on your side.
Yeah.
And things will work out.
All right. So, any advice for anyone running or thinking of starting a business in as far as credit scoring and just making sure that they generate and build a healthy credit score record?
Look, what I'd advise is that make sure you don't open too many bank accounts or mobile wallets. Make sure it goes through one or two. Make sure where possible, you're living up to your commitments in terms of repayment. And that's it. And if you want to start a business, do it. There's no model that'll tell you yes or no, right? If your heart tells you, go for it.
Yeah, all right. And I think that's a good place to end it. And we have been speaking to Bhartesh Shah. He's the CEO of SBM Kenya. Thank you so much for making the time to be on the show and for being part of this conversation. That's all the time we have for you. It is exactly 11 a.m. Let's do this again next week. Same time, same place.
Thank you very much.
All right. Santi sana, appreciate it.
Thank you. No.